Hello, everybody. So, HIMSS provided us a very valuable guidance during the last earnings call. They said that by 2025, they expect at least 1.2 billion of annual revenue. They also gave us more numbers on adjusted EBITDA margins and adjusted EBITDA, but this is going to be a growth company, so I still don't think we're going to be able to use these numbers to value HIMSS, because HIMSS, I think, has well over a decade of growth ahead of it, given how small they are. But we are able to use that 2025 trajectory revenue guidance to derive a potential valuation for HIMSS by the end of 2025. So we know that in full year 2022, right, ended December 31st, 2022, they did an actual revenue of 527 million. We know that they guided 755 million for the full year of 2023. That would be 43% growth. We know in 2024, we can deduce that in 2024, we would have a halfway growth. So my estimate would be a 29% growth rate for 2024 at 977. And then in 2025, they guided this. They just gave us at least 1.2 billion of guide for 2025. So I derived the 977 by going halfway and using the halfway number between those numbers. So that's my estimate for 2024. But we would have a company that goes 43% in 2023, 29% in 2024, and 23% in 2025. I believe these numbers are heavily sandbagged because of the macro. But nonetheless, they are very useful in helping us know whether HIMSS could actually be a very, very good investment. And we would find out if they reached 1.2 billion for full year 2025. We would find this out exactly in February 2026. That's when we'd know. But actually, we would have a good idea of whether they're going to reach that goal or not. We'd have a good idea probably in the second half of 2024, looking at the trajectory. So actually, we could assume that the valuation potential, right, the upside potential, would be realized as early as halfway through 2024. So very, very, very soon. But for my very simple back of the napkin calculation here, I am thinking that what if HIMSS stays at a very depressed valuation level that it has right now, which is 4.77 times sales? Right now, HIMSS is trading at a depressed valuation of 4.77x their sales, despite their stellar growth. And we were to take that 4.77 ratio, right, and apply it to the $1.2 billion in sales that they guided in 2025. That means that in exactly 3 years, in February of 2026, we could have HIMSS, provided that the market is still depressed then, we could have HIMSS valued at $5.7 billion in market capitalization. Today's market cap is 2.16 billion. Therefore, from 2.16 to 5.7 billion, that's exactly a 2.65 times your investment in 3 years. At least that's what I am hoping for my investment. No investment advice. And if you do, you analyze that, you do an IRR calculation, you're getting at 38%. 38% average return per year that you can expect with HIMSS based on their guidance. And they guided at least. They said at least. So it could be much more than that. This is not investment advice, but this is what I'm hoping for, and this is why I'm investing in HIMSS. This is explosive growth. This is the type of investment that I love to cover on this channel and buy in my personal portfolio. Now, why could they do much better than that? Well, for example, HIMSS has more products coming, and they've outlined many of these products that they have outlined here are new products, but they could move in ever more categories, even more categories that have to do with preventative care and prevention. Like a big market I'm thinking of, they could move is, for example, diabetes, for example. Anything that has to do with longevity treatment, resveratrol, NMN, metformin. They could move into so many more areas, some of which I know about, some of which I don't know about. But when I listen to the CEO, I know that the CEO will keep adding products in the preventative care field. And that's a very, very broad, less explored field in healthcare. right? I know that HIM's revenue is very sticky. Frankly, this company should trade like a SaaS stock. They have 90% recurring revenue on 1 million users, and their gross margin is not close to that of a traditional healthcare stock. Their gross margin is that also of a SaaS stock, and the recurring revenue obviously helps. They also own 2 pharmacies, right? One in Phoenix, one in Columbus. These pharmacies obviously help drive these costs down. So you have 75% gross margin profile, 90% recurring revenue. This company's valuation should be much closer to a SaaS stock. And maybe sometime at some point the market will pick up when it stops to associate HIMS as a SPAC. HIMS has a strong brand. They are a customer-centric company. They're trying to develop the first actual brand in healthcare. They are replacing things like the name of molecules or the name of single drugs that have stigma attached to them, like Cialis, like Viagra. These are not fun drugs to think about. They're trying to replace these umbrella terms or generic for Viagra. They're trying to replace that with HIMS for male and hers for women. They're trying to move away from these scary branding and scary molecules names to their own brand. And when they have their own brand, that means that customers are going to start to love HIMS. And when they start to love HIMS, when people love a brand, they start using that brand to refer to the business. You don't buy something online, you buy something on Amazon. You don't buy generic Cialis, you use HIMS. That's where brands are headed. And when you create a strong brand, which I believe they're creating with their partnership with their social media, you're going to have a lot of word of mouth. Word of mouth of millions of users. Word of mouth, right, leads to cross-selling. HIMS can sell more products to each users, and hopefully not, right? We don't want that. We want this company to be loved. So we don't want this company to push products that are not needed. But when products are needed, this company needs to be effective and actually solve the problems. That will lead to greater word of mouth. There is also great opportunities, I believe, for cross-selling across users, because when you think about a lot of the products that HIMS sells, they're products that are mostly dedicated for couples, right? Whether it's birth control or ED or PE drugs, that's all about couples. So obviously, if a member of a couple, if he uses HIMS, she might be compelled to use HIMS for something else. There is cross-selling across couples. There is cross-selling within users. And, that's why this marketing is so important. That's why the superior marketing that they have, I believe, is going to help them beat this guidance handsomely, which is why I'm buying the stock. I bought more of the stock today on the drop. And, I'll finish with this less timely discussion, more of a today thing is, what is it? What I'm staying the course with HIMS. Like, I know HIMS went down today. It went down more than 10%. That doesn't faze me. Why does HIMS go down? Well, look, they only have 58% institutional ownership, right? Your average stocks in the indices is gonna have what? In the high 80%. So, right, this is not a stock that is in the indices, which means that whenever you have a little bit greater than usual edge trading, that stock's going to drop much faster. On the upside, that means it can go up much faster too. But that's one aspect. That's one reason why the movements are so stark. And another reason is they have a tremendous short float, right? Because HIMS is considered a SPAC. It's treated and traded with buckets of other SPACs. And some SPACs have been scams. So some algos, some hedge fund managers don't do the digging that I did, that we do. They don't dig, and they think SPAC equals bad equals I sell SPAC. And why would they want to sell SPACs right now? Because look at what happened to the 10-year yield, right? It is risen back to the awful levels of October. The yields are very high. Mortgages are back up to 7%. So what does that mean? That means that there is a general fear of recession, and there is a general fear of the Fed having to hike rates more or hold them up for longer. But this is irrelevant to HIMS, in my view, because HIMS is dealing with a recession-proof product. You know, I'm pretty sure there's plenty of men and women who use Hims products who would rather skip a meal than skip Hims products. Like, these products are fundamental to one's well-being. You know, ask yourself, look at the products that they have and ask yourself, you know, if you lose your hair, you're going to be depressed. It's fundamental. Say, for example, if a woman loses their hair, does that make sense what I'm saying? It's like these are recession-proof products. It's not like people are gonna cut these, especially if they've been able to resolve, control, or they are on the way to actually dealing with their issues. I don't think this is a product that people are gonna cut as easily as a Netflix subscription. Health is very personal. It is much more fundamental than, you know, say entertainment I hope you see what I mean here. So I'm not too concerned. The growth rates of this company are so high, and they are targeting fundamental problems that I believe people will keep spending on. And not to mention, they are a low-cost leader. They are much cheaper than the traditional face-to-face healthcare alternative. If you watch my former video, you may have seen I talk about being excited that it's only $99 for a visit with a doctor with Hims, right? That doesn't happen anywhere in the US, that you just pay $99. They are a low-cost leader as well. What happens when you have a recession? If that recession, you know, endures, what happens? Well, more people are going to look for low-cost options. Remember the video I made about the cost of Viagra and how much these pills cost? Like, Hims is more than 10 times cheaper, between 10 and 20 times cheaper. It's about, their prices are about $3 a pill. Viagra is still well above 30 a pill. So does that make sense? Like, they are a low-cost leader. They have a recession-proof product. Right now, a lot of risk assets are selling, not just Hims. If you look at the market, not just Hims, right? Snowflake, Tesla, these are just the few that come to mind from today, the stocks that have been in free fall. Why? Because they're risk assets. The market doesn't think long-term. The market does not think about 2025. 2025 trajectory, we'll find this out in February of 2026. The market does not wait until 2026. Most analysts, and I saw in my comments someone talking about analysts. Most analysts have a 12-month price target. We don't invest for 12 months. I don't invest in Hims for 12 months. Hims is a 20-30 hold for me. The 12 months price target has no impact for me. So that's why I believe there's been just a little sell-off today. As simple as the 10-year is on its way up. Everybody's freaking out about the 10-year and the Fed doing one more hike or two more hikes or keeping rates higher up. And this company is not in the indices. It has low institutional ownership, and to add on top of that, it has a short ratio that's pretty high because it was a SPAC and it IPO'd through a SPAC. So that's it. That's my view on it. I was very happy to add at these levels. Thank you so much for watching. This was not investment advice. I hope you liked the video. This is just entertainment. I appreciate all of the likes. I appreciate your subscribe. I appreciate your time. Thank you so much for watching.